Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And many of you also know me as Mr. Valuation. In fact, most of my work is actually done talking about attractively valued stocks, primarily dividend growth stocks, but I also like to talk about growth stocks, like to talk about REITs, MLPs, even things like mortgage REITs on occasion. But my real passion is valuation. But the reality of it is, in today's marketplace, especially if you're looking at what I would call the blue chip crème de la crème of all dividend growth stocks, the Standard & Poor's Dividend Aristocrats, and these are all companies that have had a minimum of 25 years consecutively of increasing dividends. Some of them have actually increased their dividends for 30, 40, and 50 consecutive years. So these are really the best of breed dividend growth stocks. And, but the problem is it's very difficult to find any of these truly pure classic, blue chip considered dividend growth stocks at attractive valuations today. So I'm going to go through a list of 20 of them. I'm going to go through them very quickly, and I'm going to go through them kind of superficially. But what I want you to understand is these are all businesses that I love. In fact, these are easily some of my favorite stocks on the planet. The problem is I don't see any of them being attractively valued. And I want you to see that, and I want you to try to understand that clearly. And then finally, something I'm extremely excited about. I'm going to do this with the new version that is currently being tested, of our new version of our FastGraphs Fundamentals Analyzer software tool. It's very, very fast, and I want to showcase that. And because not everything is functioning, I can only use it at a limited basis. So I'm going to be looking at historical graphs. I'm going to look at operating earnings, but I'm also going to look at operating cash flows, because cash flow is really what investing in dividend stocks are all about. And what I'm going to be primarily looking at are operating cash flows and free cash flows covering the dividends of these great stocks. But I think every stock I'm showing you here is one that I actually consider to be overvalued. In other words, I'd love to invest in them, but I think we need to wait for better entry points, because I do believe with this low interest rate environment, the market has become quote unquote irrationally exuberant on these stocks. So let's go ahead and start looking at some of these names, and you'll recognize the majority, if not all of these names, as I go through them for you. And again, I'm showcasing the new version. So the first one I want to start out with is automatic data processing. Extremely high quality company. Earnings growth has been about 8.44% a year, offers just under a 2% dividend yield. But I want you to notice the earnings yield is only 3.13%. Now, when you look at this graph, the fair value line would be a PE of 15. But I had a comment, a subscriber asked me if, PE ratios have memories. And I don't particularly believe they have a memory. I do believe that a fair valuation calculation is a function of getting the proper earnings yield. It's a cash flow based mathematical equation, but in reality, the market is also a voting machine, as Ben Graham once said, meaning that people vote with their dollars. And ADP is a stock that when you measure it, looked at adjusted operating earnings like I'm doing here with adjusted operating earnings, the market has put a high valuation on this stock historically, somewhere around 25 times earnings. As you can see here, 24.98 is actually the PE ratio of this blue line. Now, coming out of the Great Recession, it got down to where we had, actually you could buy it at a 15 or less PE ratio for a couple of years. What a great time to be buying this stock. But here's the other thing. When I'm evaluating these kind of classic blue chip dividend growth stocks, frankly, I like to look at operating cash flow more than I do even as a valuation reference than I do operating earnings, because cash is what the dividends are paid out of, and dividend growth stocks like these aristocrats are really all about the cash that they're generating as businesses, and then how much of that they're sharing with us, the shareholders. So the white line is the dividend, and you can see the payout ratio of this stock has been very low historically. More recent years, it's increased to about 40%. You can see it in the pop-up. It's up to 50%. Last year, the dividend payout ratio was a solid 50%. But the point is, operating cash flows have grown by about 7.3%. And I want you to take note of the fact that the price has tracked that pretty consistently over this time frame. Now, more recently, currently, if you will, the stock is trading at a blended price to cash flow of about 26, and it's normally trades at about a 15 or lower. Notice how many times it's actually traded at a PE or a price to cash flow lower than 15. So to me, this is clear indication of excessive valuation. Now, if I go into the forecasting tool, and look at forecasting going forward for the next couple of years, and that's as far as I want to go, we're looking at about a 5% growth rate going forward. This would have negative rate of return connotations for the next couple of years based on the valuation. I couldn't find a stock with a more impeccable historical record, but the key is that to me it's become significantly overvalued in the last several years. But also note that it's lasted for several years. And that's the problem. They don't ring a bell at tops or bottoms of the market, and the market can be irrational for long periods of time. But eventually, as I'll show you in some other examples here, the rubber hits the road. So this is looking at automatic data processing through the view of operating cash flow. The next stock I want to go to is Albemarle. Notice how quick the stocks load here for those of you who've been suffering with the slow loading speeds of fast graphs for so long. I've written about this recently. I've primarily looked at this stock with adjusted operating earnings. So I'll go ahead and put it into adjusted operating earnings for you. And you can see the price tracked operating earnings. Then, with the rise of EV electric vehicles and Tesla, we saw this, huge run up in the stock price. And then it hit sort of a bump in the road. They actually postponed the opening of a lithium plant. This is one of the world's largest lithium producers, and the stock took a major hit. And then, Tesla and everything's become hot again, and you can see the stock has risen again up to very, astronomical valuations based on earnings. But once again, if I go to operating cash flow with this company, two things I want you to notice. The correlation here, the stock has traded at about 11 times operating cash flow, currently trades at almost twice that, 22 times operating cash flow. Another pure indication it's overvalued. But also, as I'm going through this, I want you to note that operating cash flow is covering the dividend by a very large margin here. The operating cash flow payout ratio is only 17 or 18%. Now, even if I move this and go, further down the chain into what I call the real acid test, which is free cash flow, which is what's left over if they're running the business, we get a slightly different picture here. And this actually disturbs me. Free cash flow has been negative for the last several years. And this is during a time when the valuation on Albemarle has been exceptionally high. That's something that I would be concerned about, with the stock trading at these high valuations. The next stock I want to go to is Air Products, and here's looking at free cash flow. Once again, I want you to notice that you're not seeing free cash flow, obviously, always covering the dividend over this time frame. However, if I go to operating cash flow and run Air Products based on operating cash flow, you can see that it's covering the dividend, very strongly with operating cash flow. And that's a good sign. This is a dividend. All of these are Dividend Aristocrats, I want to remind you. But again, look at the correlation. This is normally an 11 or 12. And by the way, these numbers I'm actually thinking about having the guys put 15-ish, 11.75-ish, because these are valuation references, but valuation is always a range. Anyway, this is normally an 11 or 12 times, operating cash flow stock, and it's now trading at 19 times operating cash flow. And you can see it's got very extended. So the blue line on this particular metric, I think, is actually more important than the orange line in this example. Anyway, that's Air Products and Chemicals, another blue chip Dividend Aristocrat. Here's Colgate-Palmolive. Once again, you see a pretty good correlation between price and cash flow. It's coming out of the Great Recession. The market's been valuing this at a very high price to cash flow. When I look at this from adjusted operating earnings, you get this point where the market likes to put this at a very high valuation. But even now, that valuation is high. So what this means is, if I'm looking at forecasting and going forward, this company's forecast to grow at about 4% a year. Historically, just to put that in perspective, it's grown at about 6% a year. It's becoming a very large company now. We don't have market cap working on the new version yet. That's one of the reasons why it's not launched. But the point is, this is a very large company now. And if I look at operating cash flow, you see that the stock is trading at a very high multiple of operating cash flow. This is not an optimum time to invest in this stock. In fact, at these very high valuations in recent years, there's 19 times cash flow. So that's pretty close to what it's currently trading at. So in other words, when you pay the high valuation like that, you end up with rather low rates of return. That's the key about valuation. It's not that you'll lose money. It's just that you don't participate fully in the growth of the business. The next stock I want to look at is Clorox. And this one I think really tells a nice story. I'm looking at operating cash flow again. I want you to see a nice correlation at around a 15 multiple, 14 or 15 multiple. Many times you can buy Clorox at 10 and 11 multiples. As you can see as I'm rolling my mouse here on the orange number at the bottom. Now we've got it at 18.69 times cash flow. But it wasn't too long ago where it was trading at 19.6 times cash flow. And that now has, fallen dramatically. You can see this, big drop where it's starting to move back. And that's because we've had a down year at cash flow probably stimulated that. But the dividend is extremely well covered. It has a 2.25% dividend yield. It's just not an optimum time to buy Clorox. I'd love to own Clorox, but I want to buy it when I can get it at a bargain with the margin of safety that I talk about all the time. The next one is Cintas Corporation, another great blue chip. When you look at its price to operating cash flow, you can see that it's extremely highly valued right now. If I look at it from a standpoint of adjusted operating earnings, you can see this is another example where the market likes to put a high value. This is such a blue chip dividend growth stock, but the problem is the valuations here are just completely ridiculous relative to historical norms. When I look at this stock from a standpoint of free cash flow has been covering the dividend, which is really, like I say, the acid test, something we didn't see, for example, with Albemarle earlier. But when I look at operating cash flow, I've also got really good coverage, but I simply have high valuation. What this simply means is if this stock moves back into the normal range of valuation that it would, normally trade at, you could see a 16% annualized, a 33% total drop in value of this stock before it got back into alignment with fair value. I just don't think, that's certainly not a bargain, and that certainly doesn't have a margin of safety. The next one I'm going to look at is Ecolab. Ecolab trades at a relatively high multiple of somewhere between 15 and 17 times cash flow. Under normal times, it's currently trading almost double that at 33 times cash flow. Just a clear indicator. Now, this stock has perennially been overvalued based on earnings. It's traded at about a 25 to 28 to 27 multiple. The blue line here on this particular iteration is a price to earnings of 27.28. Currently trades at 51 times earnings, and that's with earnings actually dropping. This is a clear indication that this is a great dividend growth stock. It's just simply significantly overvalued right now, and it is. Now, Emerson Electric is actually a more cyclical version of a Dividend Aristocrat, but even then, you can see it rarely gets above this PE line of 18, and when it does, it normally corrects very quickly. It's now trading at 25 times operating earnings. When I look at this more cyclical from a standpoint of operating cash flow, it's a little more benign. You can see it's normally at 12 times operating cash flow, trading at 15 times operating cash flow. These are clear indications of overvaluation. I believe this is all a result of the demand for dividend growth stocks increasing because there's no real yield available on bonds right now. And I think that's, really the real issue here. The next one I want to look at is Hormel. I'm looking at it here through operating cash flow. You can see that it's normally a 15-ish operating cash flow historical valuation, currently trading at 23 times operating cash flow. I believe that's just excessively expensive. If I look at it with operating earnings, in this, I'm not getting any picture here, but you can see based on the 19 times operating earnings that, the stock is excessively expensive right now. Just the nature of the beast in today's low interest rate environment. This is Illinois Toolworks, a very high quality dividend growth stock. You can buy this stock many, many times at a 15 multiple if you're patient. But on the other hand, the market likes to put about a 19 or 20 multiple on this stock. Currently trades at 32 times operating earnings. When I look at it from a standpoint of operating cash flow, I get around a 15 times cash flow. It's currently trading at 25 times cash flow. And again, we saw that just recently where it was up here at, slightly less at around a 24 times cash flow. And over the next year, that led to a, 27% negative, growth, if you will, a 27% annualized loss over the year. And then, of course, but then it rallied again. The key is when you buy it, if you bought it here, when the valuation was very high, you end up still making 10% a year. Valuation doesn't mean you're going to lose money. I think that's a misnomer. But yet, on the other hand, if you buy better valuation, instead of earning 10%, you earn almost 30%. So valuation is very important as far as how much money you're going to make as a shareholder in any of these wonderful companies. So anyway, that's 10 stocks. Now I'm going to take you and look at 10 more classic, growth stocks, dividend growth stocks. Here's Coca-Cola. This is another Dividend Aristocrat. Market likes to put a premium valuation on this one, clearly. However, if I look at it from a standpoint of operating cash flows instead of operating earnings, we do get a different picture. Now, the market still likes to put a high valuation, but now a 20 multiple times cash flow is actually on the high side, as you can see. It's sold at many, many times, at 15 and 16 times cash flow, and it's trading at about 22 times cash flow now. The problem, though, is when you look at a Coca-Cola, look at it from a forecasting point of view, there isn't a lot of money to be made in this stock over the next several years. If I look at it at a normal multiple I'm using a 23 multiple here, there is some money to be made in Coke. But the point is, you're not buying this stock at a great bargain today. It's not crazy overvalued like some of the others I've shown you, but definitely overvalued. Next, I've got McDonald's. This is normally a 15 times operating cash flow or less. Again, there were times you could have bought it at single digit times cash flow, 9 and 10 times cash flow. Today, you'd have to pay 25 times cash flow. That makes it very vulnerable, in my opinion, over the next year or two to generate a negative rate of return. The dividend yield is about 2.19%. You want to buy this stock, historically, when you could get dividend yields of over 3%. That's when a stock like McDonald's has really always been the best buy. It's not such a great buy when the dividend yield is below 3%. Just another way, to look at these stocks. The next company I'm going to go through is Medtronic. I love the Medtronic story because if you go back and look at Medtronic historically, I want you to notice it was very overvalued in 2000. And this is an idea of how irrational the market could be for how long. If you held that stock, and not until it crashed in a recession, but when it stayed at a pretty high valuation here, I bought it at a high PE, and now I've held it to a 16.9. I ended up making 1.3%. This is the quintessential definition of a lost decade, if you will, where there was no money to be made, even though the business did pretty well. And I'm looking at operating cash flow here. If I switch this to adjusted operating earnings, you even get a clearer picture of how overvalued the stock was and how poor a performer it was. And here you have a better example of how steady the business was able to generate profits and grow profits at a very nice pace, but yet shareholders didn't make any money. If I carry this all the way out to where it bottomed, you could have owned this stock for more than a decade and actually lost money. Annualized rate of return was negative, minus 2.5%. And yet, over more than a decade here, the company grew earnings at a very fast rate. In fact, if I can grab my scroll bar here and bring that back to approximately where we are here, you'll see that the business actually grew earnings at almost 12%. And yet shareholders, and I'm not going to hit this in exactly like I did before, but I'll get close enough. Shareholders would have actually lost 1.1% annualized during a time when the business did 11.8%. That's why you've got to be careful. The idea of buying fair value is to participate in the growth of the business. When you overpay, you get less. The next stock I want to look at here, and I'll go ahead and scroll this back out, is McCormick and Company, the spice company. This is operating earnings. The market does, often put a premium valuation on this. When I look at it through the standpoint of operating cash flow, it's around a 15 to 17 operating cash flow company. Today, operating cash flow is almost 23. Again, a low dividend yield of 1.24%. If I was looking for good value for this stock, I'd want to be buying it when the dividend yield was well over 2%. And ideally, if I can get it when the dividend yield is almost 3% or 2.5% to 3%, those are the times when the valuation of the stock is actually the best. Right now, I don't believe that makes a lot of sense to be investing in McCormick. The next one is Procter & Gamble. Now, this has a really high correlation with operating cash flow. It typically trades at around 14 or 15 times cash flow. That's the blue and orange line. You notice they're almost converged here. Now it's trading at over 19 times cash flow. Just another clear indication that the stock is overvalued. And worse yet, forecasting, I don't think this stock is going to grow much more than 3 or 4% a year. So you really could see negative rates of return at, 15 times cash flows here, if the stock, reverts to the mean like it has all these historical years here. The next big name is Roper Technologies here, and this one's classic, always traded at 15. Now with low interest rates, demand has driven it up to almost double that, 27 times. I'm looking at operating cash flow here. Dividend yield is now less than 1%. This is a very low payout ratio company, so the dividend is very secure. And the company has had a very excellent record of growing the dividend historically. I don't have my performance tool working totally yet, but you can see that, it's been a great growth. The dividend went from 15 cents to, expected to be $2.25 this year. It paid $2.10 last year. So it's got a great dividend record, but strictly a very high valuation. The next one we'll look at is Sherwin-Williams. When you look at Sherwin-Williams from a standpoint of operating cash flow, I wanted you to focus on the blue line here. It looks moderately expensive. When I look at it from a standpoint of operating earnings, however, I think this is the truer picture in this example of how expensive this stock has gotten. This is a very hot industry right now, but the stock has become very, very expensive, and I'd caution you. I'm not sure this data is correct. Remember, this program is still being developed here. The next is Hormel, which I already showed you in the previous graph. I want to look at S&P Global. This is Standard & Poor's Corporation, if you will, where we buy our data. We get our credit ratings and our GICS codes. And again, you see a great historical record, almost 12% growth. You see a normal price to operating earnings is somewhere between 15 and even as high as 20 times earnings on a lot of occasions. But now we're at over 30 times earnings. When I look at it from a standpoint of operating cash flow, you can see it's really separated itself from its normal multiples of operating cash flow. And there was a time here in 2015 where operating cash flow didn't even cover the dividend. Let's go ahead and take a look at free cash flow, since this is my last one. And, free cash flow also was negative in 2015. It did not cover the dividend. But anyway, what's really happened here is the stock has become excessively overvalued like most of the dividend growth. There's only a handful of dividend aristocrats that I believe are attractively valued today. That's the nature of the beast. What's the answer? Look for value and only invest in those stocks that have good, valuations now, names like AbbVie, and, I've shown so many others in the videos I've recently produced. Anyway, this has been Chuck Harvell saying, hope you enjoyed this look at some overvalued dividend aristocrats, some companies, all stocks that I love dearly. I think they're great businesses. I love their businesses. I don't like their stocks now from a standpoint of valuation. No margin of safety. They're not bargains. They're very expensive, and that means that I can't really participate in all the beauty of the businesses that I see here as a result. Thanks for watching. Give me a like, give me a thumbs up, ring the bell, and subscribe to the channel if you haven't already. Thanks for watching.